Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Bill Mitchell. And Bill is a certified public accountant, and Bill represents taxpayers in IRS collections, audits, and appeals, and the U.S. Tax Court. He has offices in Santa Cruz and San Jose, California, has also been licensed to practice before the United States Tax Court since 1978. Bill graduated from Santa Clara University in 1962. After his service in the U.S. Army, he worked at the Internal Revenue Service from 1966 through 1971 and has worked in public accounting from 1971 to the present. So, Bill, thanks for joining me today.
Oh, thank you again for inviting me. You know my background probably as well as anybody by now.
Okay. Anyway, today I've asked Bill to provide some guidance about dealing with IRS collection issues. In other words, I owe back taxes, now what? And when we're doing this, we're covering highlights of a complex subject, and so this is the beginning of a conversation. Please consult with a qualified tax advisor about your situation. Bill, when you don't have the money to pay your taxes, does that mean that you're a bad person?
No, not really. I mean, especially in today's economy and with the activities and endeavors in which taxpayers involve themselves, you could get a reversal on your business fortunes, and all of a sudden things that look like they were going to be the dream of great success or a financial disaster. And on top of that, you get a tax bill and you can't pay.
All right. Okay. Do you deal with the same people at the IRS for collections as for tax audits?
No, there's a whole collection department at the IRS that's separate from the audit section, and revenue agents deal with audits, revenue officers deal with collection matters. And so when the revenue officer, the collection party, gets the case, usually all the issues that were at odds or at issue are no longer at issue. Now we're just talking about, here's the money that you owe, what's next?
Mm-hmm. Okay. So can you tell us a little bit about how the collection process works?
Well, as I mentioned, after the audit is completed and the matter gets assessed on the IRS rolls, and if it's not paid in a short period of time, then you'll start getting letters from the IRS collection department. And I don't know of any direct contact by phone from a revenue officer. The thing usually comes with a letter saying that your tax liability for 2012 is X amount of dollars, and please contact us if you are going to resolve this, or if there are situations where there's going to be problems paying it. I mean, I'm paraphrasing now, but that's the essence of the letter.
Yeah. So maybe we should just briefly, because these days the IRS is very concerned about identity theft and fraud, basically people representing themselves to be working for the IRS. So if you get an initial contact from somebody that says, "Hi, I'm from the IRS, you owe X dollars, and if you don't, take some action immediately, we're going to take your house and you're going to jail."
Right.
That's happening an awful lot.
It is. It's happening because I get calls from clients. I prepare taxes just as most CPAs in taxation do, and in addition to my representation services. And there is a common thread that on some of these where you're getting phone calls from that start out, if you can identify where the phone call emanates, from Washington, D.C., and they're saying, we're going to, unless you pay, there's going to be a lawsuit against you. I mean, just wild allegations that just strike fear. But most taxpayers are pretty sophisticated as to that, knowing, hey, normally you don't get contacted by a collection department via phone call. It's a letter that comes out on IRS stationery that tells you that you've got an amount due.
Yeah, so particularly from the IRS. So if you get a telephone call or an email as an initial communication about something like this, then hang up the phone. My wife actually starts getting belligerent with whoever's on the phone and telling them that they're criminals and so forth. But anyway,
and they'll hang up. You know, what'll happen is that if you pursue it, one of my clients did pursue it, and then because they had been wary of that type of thing, and then the other party hung up. You know.
Yeah. Okay. So why don't you tell us a little bit about how the collection process works?
Well, after you get your letter, and if you can't pay it, then you can contact. Generally, there's a contact person that comes out. That you contact that person for purposes of possibly going on an installment program, or even requesting a meeting with a revenue officer to see what can be worked out. The big thing when you get those letters is to respond, because if you don't, then you'll get a second letter that is a little more direct, and then finally you'll get a third letter that's very direct. It says that we're going to levy or seize, and then there's another procedure that you can use at that point when you get a letter of notice of intent to levy. If there are legitimate reasons that you want to put forth why the IRS shouldn't proceed in that manner on an amount you owe, you can put in for what's called collection due process. A good example of this is a case I had where a businessman had reverses in his business, but yet there were tax liabilities that arose from it, and he couldn't pay the liability. It was a significant liability, but what he intended to do, he had a second residence that had great value, and so that we put in a collection due process, saying if you give us time to sell this residence to pay the tax, then we will take care of things. And the service is pretty understanding with respect to that, because they'll allow you the time to providing you do all the procedures, you know, that what's the value that we're talking about, have you got a sale in place, and this type of thing. And if that's the case, then they'll hold off on doing any levy action or seizing action, and then you can get the matter resolved in that fashion.
Mm-hmm. Okay. So what's the key to avoiding a horror story for your collection issue?
Well, I think it's communication. It's just don't ignore them, because if you just ignore that last one, it says notice of intent to levy, your bank account's going to be reduced. And sometimes you'll hear the story. People will say, "Well, I had no idea that was going to happen." And on this time, I would side with the service. Usually, they've given you ample warning about it. You either haven't been opening your mail or been gone away from home for a long period of time, because you've given fair warning. But if you, on the first or second ones, if you get a communications established, usually you get it taken care of. But if you get that third one that says notice of intent to levy, then if there is still a legitimate argument for holding the service off or working some arrangement out, then you can file what I said earlier is a request for a collection due process hearing to see if there's some way that this thing can be resolved without having levies or seizures.
Mm-hmm. Okay. What are the consequences of a late tax payment?
Well, there's late payment penalties. That's one thing. Other than that, I don't know what else there would be, other than that you owe the tax. You're going to get penalties on top of that, plus interest. So that can be an expensive process if you've had a thing linger for a long period of time.
Right. And if you can pay it on time, then you don't have to pay somebody else to
Correct.
Help you to take care of it.
Yeah, right.
So what are some alternatives, again, to full payment of the tax?
Well, you have the installment agreement that you can work out where they'll let you pay over an extended period of time. But those are usually weighted in a manner that given the taxpayer's circumstances at the time, they can be uncomfortable. It looks reasonable, but given their particular circumstances, it makes it a little more difficult to accomplish, but that's available, and there are installment agreements that have worked. Another alternative is offers in compromise, which is a whole another area in which I provide services, and that seems to be an active area right now where the service has supposedly come up with a new start program or fresh start program, and it's still the same old offer and compromise situation to some extent, because they retreat from some of the favorable provisions. And I give you an example. To do an offer and compromise, what has to happen is, and I give you an example. Let's say the government says you owe $500,000 in tax. You've had a disaster in your business. You don't have the money. So when you file for an offer and compromise, you send in a financial statement on a Form 433A OIC that shows you what the value of your assets are. And there's a second part to it that shows what your monthly income is, and the IRS allows you certain deductions that aren't necessarily tax deductions. They're deductions for food, clothing, and the like, transportation. Mm-hmm. And that net amount on the Fresh Start program is multiplied by a factor of 12. So if you have a $500,000 liability, let's say, and you have this probably doesn't exist in this area, but a $300,000 residence free and clear, and you have this other computation that comes to $100,000, the total of the assets and the income factor in it will come to $400,000. So you owe $500,000, this comes up to $400,000. The IRS will say, well, in that case, we'll accept the $400,000 as a satisfactory situation. I've recently had a case where the amounts were much more disparate. You had a $900,000 liability, and the taxpayer's original offer was submitted at $7,000 on the Fresh Start program. And this was a little bit of an eye-opener to me, because I multiplied by the factor of 12 on their income computation, and the offer and compromise person came back and said, no, there's 48 months remaining on the collection statute, and you have a 10-year collection statute, so we're going to multiply by a factor of 48. And so right away I went back to, hey, wait a minute, now we're going back to what the old regime was. But the service still pursues that. So you have to be wary of that when you put in an offer and compromise, that the service is still going to not only look at the computation that's on the Form 433A OIC, but they're also going to be looking at how many months or years are remaining on the collection statute. And that's always been the case, but I was surprised it still was on this particular circumstance. And I rebutted it, saying, well, we're going back to the old regime if you do that. And secondly, it discourages a taxpayer from coming forward early in the process, because if you can't pay and you're early in the goings, and maybe there's 8 years left on the collection statute, then I don't think they're going to multiply by a factor of 96, but they're going to look at that and make their decisions. And the other thing is that once an offer is in, the service can do three things. They can accept it, and then you're in pretty good shape, because you sign a contract with them that you will make the payments, and you will be current on your taxes for the next 5 years in filing. Or the service can reject it, and in which case you can file a protest to their rejection. And this case that I had recently, they did neither. They didn't accept initially, and they didn't reject. They said, we're returning it. And in which case, the understanding there is that even though the case was originally worked by a an offer and compromise person, that the whole understanding is that this thing should never have been accepted in the first place, so therefore it didn't exist, and we're returning it, and you can't even file any appeal on it, or because it's not a rejection.
Did you keep the money?
Well, that's interesting. They did, and here's what happened on that. Because they did keep the money, I filed for collection due process, and we got an appeals officer in Fresno who was really upset that when the thing was returned, that the service kept the money, and that brought the whole case back to life with this appeals officer. And believe it or not, we eventually got a $900,000 liability settled for $30,000. Okay. So it can happen, but sometimes you have to. I mean, and these are the people on this that I was dealing with on the service. There's no heated discussions or anything. We're just going through these things, and some of these things you start getting told, hey, this is the way it is, and you feel, wow, that just doesn't sound right. How can we deal with this?
Okay, so we've been talking quite a bit about offer and compromise, but just to bring a reference to people. So when you see these ads on television about supposedly resolving your tax liability, for a fraction of the original one. You gave the example of the $30,000 settlement for $900,000. That's what you can do sometimes with an offer and compromise. But I guess one thing is I want to emphasize, and maybe you can speak to this, is that this isn't a lay down or a slam dunk.
No, it isn't. In fact, $30,000 is a significant amount of money. Yeah. And if this person is in that, the person that is putting in for the offer and compromise, they're putting in because they can't pay the tax, and they probably can't. They cannot pay the offer amount either. That amount generally is provided by a friend or a relative in almost every case. It's certainly not going to be provided by a lending institution because their financial circumstances will show that that's not a feasible thing. So even now on the offers that are the paperwork that's put out on the offer forms, is one of the questions the service has is who's going to pay the offer amount. And in the past, that was never reduced to writing. A person that pays the offer amount on behalf of a taxpayer isn't obligating himself to anything, really. Sometimes people might be a little skittish about that, saying, am I a guarantor? No, you're not a guarantor. And I've had cases where people were put down as the party that was going to pay the offer amount, and then during the course of events between getting the matter hashed out and finally getting to a point where we're going to settle this, there may have been a falling out between the taxpayer and the person that was going to pay the amount, and then the whole thing dissolves. But the person that is put down as the one responsible for paying the offer is not held accountable by the service.
Now, when you apply for an offer and compromise, aren't you required to make a deposit?
Right, you got to deposit 20% of the offer amount, and that's non-refundable. And also, you have to pay a fee of $186. Two separate checks go in with an offer, so that gets you off and running. And then again, that these are, for example, on an offer that where someone, it turned out that this particular offer where I mentioned was $30,000, you'd have to make a deposit of $7,500 or $6,000 rather to get the ball rolling. So those are significant dollars. It's not just done easily.
Okay. So a few minutes left here. What kind of amounts due to the IRS are dischargeable in bankruptcy?
Well, income taxes owed, liabilities for income taxes are dischargeable in bankruptcy. And to get dischargeable, you have to be talking about tax return years that are 3 years or older before the filing of the bankruptcy. They have to have been filed 2 years before the filing of the bankruptcy, and they have to have been assessed 240 days before the filing of a bankruptcy. I don't get into bankruptcy. That's not under my purview. Generally, you need an attorney that's specialized in that, and they can give you all the details with respect to that.
Right. So in many cases, particularly when we're new in public accounting and so forth, we think that that income taxes aren't dischargeable in bankruptcy. But there are, as you said, some situations where it can be. And again, it's these older years. So you got to mature the the liability.
Right. Well, payroll taxes are not dischargeable.
Well, the trust fund taxes.
Yeah, the withheld
okay,
portion,
so the withheld part, the amount that the employer receives from the employee, that is being held in trust for the government. Those are not dischargeable.
Correct.
But the employer part can be, and so some of the advice that you may get is how you go about paying these things so that you can specify which taxes that you're paying, because you want to pay the part that is not dischargeable. Let's talk about statute of limitations for a moment. What's the statute of limitations? In other words, how long can the IRS take collection action for unpaid income tax?
10 years, and that can be extended by, I don't know why a taxpayer would agree, but it can be extended, but 10 years is the collection statute.
Okay. Would you like to say maybe something briefly about putting together an installment agreement, how you go about doing that?
Well, it's usually a negotiation with the revenue officer, and as I said, they will give you a program that is feasible to some extent, but sometimes a taxpayer will be in a position where maybe they have an income that's not steady, they're self-employed, and that can get into where, hey, they can make some payments, and then all of a sudden, I can't do it because the revenue isn't there. So they get a little bumpy, but I haven't had any experiences where that has totally failed. We had one going where the client was making the payments, and then things would come up, and he would fall behind, and he had, again, here's a taxpayer with a second residence, and the revenue officer was very lenient and said, well, we can always look at that second residence, and if you're going to have trouble keeping up with the payments. And this went on for a couple of years, and finally it got to the point where the revenue officer said, look, either you sell that second residence because you're not making your payments on the installment plan as we had projected, and it's not because you're a bad person, it's just because of the way the revenues are coming out, that if you don't sell the residence, the service will sell that second residence for you. So that prompted the taxpayer to get moving, and so he did sell the second residence, and eventually resolved it that way. But installment programs are tough from the standpoint that you're dealing with future events and revenues that may or may not be there, and so it's one of where you really have to work with the revenue officer who's in charge of the case.
Okay. What do you do if you have an IRS person who shows up at your door and says, I'm a revenue officer and I'm here to collect the tax that you owe the IRS?
Call your representative right away, your CPA or your attorney. And I've had that case happen too, where it was on delinquent payroll taxes, where the revenue officer showed up and the client called, and we got that.
Yeah, I think it probably happens with businesses.
Right.
And then basically they say, I'm here and I'm going to lock your door if you don't, lock the doors for the business if you don't pay me my taxes.
They're not quite that.
I've seen that. I've heard that.
Yeah, they can do that.
They usually sort of back off. But
usually there's a little more politeness, I think.
So, I don't know, we have about a minute and a half left. Maybe you can throw out a final thought related to IRS collections.
Well, if you if taxpayers sometimes make choices that I can buy this car or I can pay my taxes, and they choose to buy the car and can't pay the taxes, I'd say it takes discipline. You're better off paying the taxes and not trying to postpone things. It requires budgetary issues and deciding things that aren't the most comfortable in the world for you, but you're better off getting those taxes paid ASAP, because if they drag out, you're just running up more expense in the way of representation, interest, penalties, and everything else. So if you have a manner of paying a tax and it causes you some discomfort because you had a personal goal in something, you might have to change your goals a little bit, but pay the tax. Keep yourself out of the anxiety of dealing with that issue.
Yeah. I think I'm going to add one thing, and maybe it's something that we should have led off with, and that is, if you have a situation where you think you're not going to be able to pay your taxes, I would say the first thing for you to do is make sure that you file your tax return on time, and preferably don't even have an extension, file it by April 15th. Because the worst penalties are late filing.
Correct.
Or failure to file income tax returns. So you can avoid a lot of trouble by just filing a timely income tax return, and then you can work through those issues for the payment. Bill, thanks again for joining me today and sharing your knowledge. Folks, hope we've given you some things to think about, and we'll see you next time on Financial Insider Weekly.